welcome to my presentation on how to catch the big swings with one simple strategy. First of all, I'm very happy to be here together with you in wonderful Las Vegas, the Sin City. Is it really sinful? I don't know. I never tested, I never tried, and I never will. Saying that, right? And no, I'm not a gambler, I'm a trader. That's why I want to discuss with you a strategy which really has an edge, which is important for us as traders. We don't need to gamble, we are traders. And also what I know, a lot of people told me, oh Wieland, I really want to learn something. Who is here to learn something? Same here, same here. So what can we learn? We can learn about one strategy that you can use more or less in all time frames, in all markets, with all products, and well, in all stages the market has. How does it sound? Good? Right, so let's go. Before we go into the strategy, there's of course a disclaimer, a risk disclosure. I don't read everything, but just that you know, the moment you are trading, you take over a risk, and the risk is that you're losing money. And if you trade, of course, you trade on behalf of your own responsibility, and therefore, you have to live with that, what you get, right? So if we all can agree on this, I'm happy to continue. All right, no one's leaving the room, means you're experienced, you know what I'm talking about. So this is me, you see myself here. This is my book about risk and money management. We had this presentation, we had the meet and greet and the book signing earlier. And also, maybe what you'd like to know about me, I'm the president of the International Federation of Technical Analysts. I'm a trader, of course. I'm a member of the Forbes Finance Council and some other things, and I'm also a world traveler on a constant basis. This means I don't return to any home as I don't have one, which is nice, so I can see the world and go where I like and meet the people I love. And that's why I'm here, right? So, if you'd like to learn more about things I do, how I understand trading, feel free to sign in to my newsletter, and I send you the ebook of the 4 biggest mistakes in trading. And with the newsletter, you get a lot of tips about trading, what's important to look forward to, what's important to think about, and what's important to manage when you trade and also when you invest. So feel free to register there. Now, I'm happy to start finally with the strategy. And now let's talk first about the idea behind the strategy. So what's behind the strategy I'm talking today with you? So what do we see here? It's a chart. We all know a chart. And now what makes this chart so special? Nothing. What we see here is we see a long move to the upside. We have kind of, let's see if I can mark something in here. Yeah, we have the laser pointer. Yeah. So we have the Corona crash, right? So this is from the pandemic. And after that, we have this very, very nice up move, this uptrend. And we also see that we have this down move with nice swings, a little bit sideways market right here, going up, doing a correction, and then just literally exploding, right? So this is the S&P 500, and this is the weekly chart. Now as traders, we're not really going with weekly charts. We go like minute, 5 minutes, 60 minutes, maybe a daily chart. But I'd like to show you a weekly chart just for the broader picture, and also to show you that also the strategy works not just short term, but also long term. Now, when we look at these charts, one of like these, what do we know? We know that to all these market stages like uptrend, downtrend, sideways trend, breakout, corrections, we have so many possibilities to trade the market, right? There are so many strategies around. We all have ours, we all know a lot of strategies, and I'm pretty sure in these 3 days you already heard a lot of strategies from my colleagues. And Over the time, and as a trader who's in the markets for almost 20 years, I can tell you one thing. My toolbox is filled to the limit. I cannot close it anymore because I have so many strategies. And I ask myself, why is that? Why do we need to have so many strategies? And I ask myself, is there a strategy that I can use for sideways markets? A strategy that I can use for corrections, like pullbacks? And also, can I use this one strategy also for continuations, like trend following? And the answer is yes, there is such strategy. And this is what I like to introduce you to. So what do we need for the strategy? First of all, we need some kind of indicator. And I have chosen, thank you so much, John. I really appreciate the development of your bands. So the Bollinger Bands. Who's familiar with the Bollinger Bands? Oh, I can skip this one. Now let's dive deep in, because I always see that people say, yeah, I know about it. But then, usually, people don't know exactly why the Bollinger Bands are the way like they are. Now let's hear John first. What is about with the Bollinger Bands? Now, Bollinger Bands are channel lines drawn in and around the price structure in a chart. Their purpose is to establish the relative definitions of highs and lows. Prices near the upper band are high, and prices near the lower band are low. So far, so good. Now let me ask you a question. We all talk about NVIDIA these days, right? Now, who of you can say with absolutely 100% accuracy that NVIDIA right now is overpriced, is absolutely too high? Who can say this? Maybe a guess, right? But with absolute 100% accuracy, we cannot say it. Is it too cheap? Too low? We cannot say it. We don't know. We never, as traders, investors, we always have to answer this question, when to enter, when to exit. And this question is related to the question, is the price already way too high or way too low to take action? And as we cannot answer this question in an absolute 100% current way, it's almost impossible to make a decision, right? We all experience this every day when we trade. Now, look at this again. What does it say? Their purpose is to establish the relative definitions of highs and lows. And this is a game changer, ladies and gentlemen, because we're not talking about the absolute high and the absolute low. We're talking about the relative high and the relative low, which changes everything. Now the question is, relative to what? Now what's behind these bands? Why do they work? Let's see. German guys, what is this? This is, as a German, I can say, I'm very, very sorry that this one has disappeared. This is a 10 Deutsche Mark bill, and we have a very, very famous German guy on here, and this is Mr. Gauss. Mr. Gauss gave us a very nice invention, and this is this one here. The Gauss bell curve. Anyone familiar with this one? A bit, yeah? And this bell curve is the basis, it's the foundation of the Bollinger Bands. Now, what is behind this bell curve? How does it work? It works like this. Now, assume we have like an assortment of, let's say, 1,000 random results, which is nothing else but market prices. They are random results, randomly. And these results, they appear like this. So, if you put to this bell curve some kind of standard deviation to the left and the right sides, it means negative and positive, you see that if you go from 0 to minus or plus 1, you will find To each side, 34.1% of all results, which are totally randomly in this area, between -1 and +1. You have 34.1 and 34.1 adds up to 68.2% of all random results are allocated there. As a trader, is this the area I want to look for trades, for entries? Not so much, right? Because this is like normal. I don't want to go with normal, right? Now, let's go further. -1 to -2, standard deviation, +1 to +2, standard deviation. We have each side 13.6%, adding up to 27.2%, right? To each side, and adding to the 68.2 we already have. Now, this area for me as a trader is more interesting because we see that the results who are randomly allocated already get lower and lower and lower, which means rare. They're not so often over there, they get rare. And the more we go to the left or the right side, the rarer these results get. And as a trader, this is what I want to look at. I don't want to have all the results coming over and over again, as they don't move too much. I want results and prices who are not very likely to appear, and if they appear, which will have a high impact. So, and this is what John also thought about when he did his bands and with the backtest. He figured out that with 20 time units and a standard deviation of 2 plus minus, the most markets between 88 and 89% of prices are enclosed by the bands, which is nothing else than this graph that we already have seen, right? So, given that, we can say that according to the Bollinger Bands, something between 90 and 95%, which comes from the bell curve, of all random results, which are market prices, are inside of the bands. And therefore, what does this mean for all the prices outside of the bands? What does this mean? Very rare. Number one. Number two, if a price is outside of the bands, what is most likely to happen? That he will return, right? He, she, it, I don't know, the price, right? So that price will return. That is most likely to happen. And as a trader, as I read this in this book from John, I felt like, wow, this is it. This is exactly it, because this shows me, first, these prices are rare. Second, these prices mark an area where the move is overstretched already, right? Where there's nowhere to go because it's overstretched, done. Now, if you look at some charts of the big moves right now, you literally feel that they are done. All we need now is some kind of confirmation that they are really done with this move, and another one will follow. Now, what do we need to do, or what can we see over there? Now, these are the bands, first of all. And you see, I mean, we don't have to count here, but it's pretty obvious that most of the prices, like let's say 90 to 95%, are within the bands. And that's all what I need to know. And now look what happens the moment the price goes outside. Is outside, pulls back in. Outside, not immediately, pulls back in. Outside, pulls back in. Outside, pulls back in. And so on and so on. Whatever chart you're looking at, whatever time frame you're using, whatever asset it is, it's always the same systematic approach. Going out, going back in. Not immediately, it would be too easy obviously, but within a certain amount of time. Now, all we have to look for right now is the moment when this happens as some kind of confirmation that this is what we are looking for. already is happening, right? So, and that's why I like to add candlesticks to this. Who's familiar with candlesticks in deep? Oh, really experienced traders here, I really like it. Perfect, now let's see if we agree on this. Because I was in Tokyo and I had the same presentation. And guys, I'm not shy. I was discussing with the Japanese about candlesticks. So, just saying that, right? So, when it comes to candlesticks, let's hear Steve Neeson. No other chart method can compete with the candles when it comes to diagnosing the health of the market. Period. And he couldn't be more right. Because it's exactly what it is. With candlesticks, it's like you're going backstage. See what's going on over there. It's like measuring the pulse of the market participants. Candlesticks are not just like price action. Candlesticks is a lot of psychology. You literally can see if traders are really upset or happy. You can see it. Now, how is this possible? First, reversal signals. Now we have two candlesticks here, symbolic of course. But what do they tell us? We have a long body. We have a long colored body. We have just barely a shadow, not just really an upper shadow, a little bit a lower shadow, or vice versa, depending on the direction. I mean, it's a model. So what do we learn? What does it tell us? What do we learn from this? Is this a sign of strength, or is this a sign of weakness? What do you think? Strength, right? This is pure domination. With a red candle, are there any buyers in place? Any buyers right here? No. This is a picture of power. With a green candle, are there any sellers? No, there aren't. This is a picture of power. If you see a candlestick like this, and now, look at this. This is off topic, but it's important to know. Now let's say you're looking at a support zone, and the support zone is broken like this. Is it broken? Yeah, for good. This is a sign where you can feel like, okay, now I can enter the trade for a breakout trade. Not what we're talking about here, but just that you know how to use candlesticks the right way. Number one. And the same is true, of course, for resistance. I mean, obviously, right? So, if this is true, and this is a picture of power, pure domination, now what is this? We don't know so far. It's weakness. It's not really strength, but it's not really weakness. But obviously, something is going on here, right? Something is wrong. Not so much wrong that we should be worried, but wrong it is. And as a trader, and I'm pretty sure we're all familiar with this one, as a trader, and we see a candlestick like this in a trade we are in, how do we feel? Ooh, not so good. Oh, honey, not now. No, not now, I have to focus. Yeah? We know about this. So what happens really here? Let's see. So we have a candlestick market which just opens, goes to the upside or the downside, depending. Then all of a sudden, everything reverses. And those who have been winners before are right now losers. And if you have been in a winning position and you find yourself at the end of the session all of a sudden in a losing position, how do you feel? Not good, right? Been there, done that. Who's not familiar with this? Thought so. Yeah, that's how it is. And now we question ourselves, we're like, okay, what can I do right now? What to do? And we're sitting literally with a finger on our mouth, hoping to get out for a decent price. At the moment the red candle breaks, the following candle breaks the low of the red candle, or the moment the following candle breaks the high of the green candle, usually traders exit with a loss, and they are right to do so. This is risk management, ladies and gentlemen. Now, if this is true, what is with this? Ooh, this is a picture of pain, by the way. What has happened here? What is this? This is brutal reversal. It's an assault already, right? Because what happened here? Remember the very first candlestick I showed you? Now, how did it look like? Like this, remember? Maybe a little bit more straight, but anyway. This one used to be a full body candle during the session. And all these people thought, okay, I got a short now. This one is falling, it's dropping, it's dropping. Really, the market drops like crazy. I have to enter, I have to sell. I have to sell here, I have to sell here. And also there's, there's this one poor guy. I have to sell here. Who has been the poor guy? I want to see all hands because we all did this. And we all know how this feels, right? It's like somebody just pulling you over. And this is exactly the thing. So all these people, all these traders, all these investors are right now in a loss. And they just have one need to get out. Now the moment the red candle gets overbought, this means the following candle breaks the top. Or the moment the green candle gets oversold, means that the low gets broken. Most traders exit their trade, and they have to, because they don't want to have a margin call if they're trading on the margin with the future, or they just cannot hold it anymore, they cannot stand it anymore. And they're right, because if you are a buyer and everything reverses, why should you stay in your position? Why? There's no reason for it. And if you're a seller and everything reverses, oh my, you're better off out of your trade. Otherwise, it would be very, very, very expensive and could cost your, financial life. So that's why it's so important for us to know and to read the signs the market gives us. So how to trade these? So usually these reversal signs, I'm pretty sure we're all familiar with this, they have names. The one is the hammer, and the second is a shooting star. So how to trade them? Now, first of all, in order to trade a hammer, we need some kind of down move. It doesn't have to be a downtrend, a down move. And a down move means we need at least 3 consecutive lower highs and lower lows. Otherwise, it's not really a move. It's something like, some choppy. And the moment this happens, and the moment a candlestick like this appears, I like to set this stop buy order, and I like to give it a little room. This means, yes, there is a spread, but I also like to give it 1 cent, 1 point, 1 pip, doesn't matter. Whatever you trade, right? So the measure of this one. To make sure that I got stopped in only when the market is really serious about the next move. For a reason. I don't want to get fooled in, and also I don't want to get fooled out just by fake moves. I want to see that the market really is serious about this next move. And that's why I leave a little bit more room. Like you go to Starbucks and you have the coffee of the day. You want to have room? And when I first did this, I said, what do you mean? So they mean for milk, right? But that's what it is. I leave a little bit more room for the market to show me, to prove me that the market, the next move, really is serious. Does it always help? Of course not. Would be too easy, right? But at least it eliminates sometimes a trade you don't want to have, right? So, saying that. Now here we have some examples of hammer and shooting star, easily to spot. Now here the first one, we have 2 situations where traders feel like, okay, I could go easily in as a buyer. Why did the first one fail and why did the second one made a profit? What do you think? I would not be the president of the International Federation of Technical Analysts if I would not have a nice answer to this. No, not volume. It's the simple basic definition of a hammer and a shooting star. Who's familiar with it? Body to shadow 1 to 2 or 2 to 1. So the shadow at least needs to be twice as big as the candle's body. Why? The longer the shadow, upside, downside, the higher the impact. This is a picture of pain. You can literally feel it. You have a really long shadow to the downside. Wow, this is pain for all the traders being on the wrong side of the trade. If you have just like a little bit, there's no pain. It's just like, well, let's see what happens, right? And also we have here the shooting star. Now look at these two. First of all, if you enter here, you are the very first in the market. There is no reasonable other entry possible. I mean, you can gamble, we are in Vegas, so you just place a limit order somewhere, but maybe you want to have some kind of confirmation, right? So having a confirmation, using a hammer, using a candlestick, you are the first, and all the trend followers, they might enter here, maybe here, but then you're already, at least with a risk-reward ratio 1 to 1.5, and already you're done, right? You hand just over your position maybe. Or you feel like, I want to be a trend follower. You see like, you have the down move, you have the correction, you have this nice shooting star right here, you have your stop sell order, you get executed, and all the trend followers, they enter right here. And this is what I mean. See this? Support zone, big fat red candle. Broken, done, for good. Right? So this is how we can read candlesticks. And this, of course, appears also for the varieties of hammer and shooting star. Means dark cloud cover, means piercing pattern, bullish, bearish, engulfing, evening star, morning star. If you put this together, you all end up always to hammer and shooting star. So it's always the same message. It takes more time, but that's it. And returning to our previous chart, what we see is that, of course, we have these reversal signs. And now look. Hey, Wieland, can I learn trading in 20 minutes? Yeah, you can. At least the technical side, not the mental side. That's the bad news about it. For this, you need a lifetime. But just for realizing and watching and seeing and finding candlesticks, easy. But that's not just the pure essence of trading, unfortunately, right? So look at this. I mean, this is no rocket science. You have here, this is the Corona high. This is the high before the crash. What do we see? Okay, maybe I can help a bit. Nope. There's no, I just want to make it bigger. But anyway, we see a dark cloud cover. Then we have here, piercing pattern, bearish engulfing, hammer, bullish engulfing. I don't know, bearish engulfing, dark cloud cover, evening star, bearish engulfing, and so on and so on. You just need to read the market. Now, who says the market doesn't ring a bell? He does. You just have to listen, right? So that's what we need to do as traders. Now let's put things together and just form really a strategy about it. So first of all, I want to combine both the Bollinger Bands and the signals from the candlesticks. But of course, and this is also what John says, and he's totally right about it, I mean, how could he be wrong? The touch of a band by itself is never a signal, never. Because if you just enter a trade because of that, you can do a lot of losses. So please don't do this. So always wait for confirmation. Now this is both together. The signals from the candlesticks, you all see them, and the Bollinger Bands. And when we remember, like 90% of all prices are within the bands, and therefore for us as traders, like not really interesting, maybe we better get rid of them as they are, as we can see right here, as they are not really profitable, right? So what is this? It's nothing what I really want to have. So therefore, we just put them aside. We delete them. Now we see that all the signals in combination with the bands give us, from my perspective, the perfect strategy. Why? Because using the Bollinger Bands, you wipe out all these choppy situations where the market goes into this or that direction and not really is sure which way to go anyway. And you just find those which are really likely to move. But of course, as a word of caution, that's not a guarantee and will never be, just to get me straight. But the probability, you can see it yourself, is very high. I'm talking about probability about 70, 80%, 60% from my experience minimum. Depending, of course, also on the way you like to manage this trade, right? So if you want to max it out, you can have some surprises you don't like, or if you just want to have some decent profits, you will have a lot of winners, but not so high. I mean, it's always this trade-off we have to do, right? Now, let's look at some examples, and I also show you how we can manage them. Now, what is this? Let me see. This is gold. This is a daily chart. It's not a recent one, but it's a nice chart. Now, with a strategy, you find the absolute high so far. Right now, we have newer highs. Right? So we already made new all-time highs. But anyway, you see this nice, beautiful, bearish engulfing here. And what happens then? Now, I want to answer this question, which I asked at the beginning of the presentation. And this was the relative high and relative low compared to what? Relative to what? Relative to their own average, relative to the average 20, simple moving average 20. That's the basis of the Bollinger Bands. And this is where the price first moves, usually. Now look at this chart. The middle of the Bollinger Bands is the simple moving average 20. What happens when the price reaches the middle band? What happens? It's most likely that the price at least bounces back, maybe reverses. That's what we don't know. So for me, this is my first profit target for a reason. I don't know if I get stopped out afterwards or if the market just tries to come back but is too weak already. You never know. Here you see prices, they return, but they never make it back to the high. Done. Overstretched, like the expander, you know? That's why I call it like this. You have the expander, it's really stretched. What happens if you release one side? Don't do this at home. It flips back. Don't put your nose or your face into the middle of it. It's not good. And this is what happens here. And this is why I really like the strategy so much. So, and also, where's my profit target for this move? The other side. So I'm going from one side to the other. First profit is where I take it at the middle of the Bollinger Band. Second profit, and for good, and then I exit the trade, is when it reaches the other side. Why? Because 90% of all prices are within the bands, 90 to 95%, as we have learned. And then I need to exit because it's most likely that the prices reverses again. And I give my profits away. And I want to do this, right? So doing this and maybe having a sideways market, you can play very, very nice ping pong with the bands and the price. And this is the only strategy you can use in a sideways market. Because if you go with breakouts in a sideways market, you lose a lot of money. You don't want to do this, right? But if you trade between both lines, upper line and lower line, like resistance and support. You can make a living with this. I mean, obviously, if you look at the right now, it's a recent situation in the markets. Obviously, we're not having a sideways market right now. We have like a crazy buying market, at least for one stock, putting everything like with them. But sideways market will come. And then you can use a strategy. You can be prepared for this. I have another example for you, and I have another example for you. So this is Forex, euro to the US dollar. It's a daily chart. And you see, you have some sideways situations. And also, just a word of caution, if you apply this strategy to Forex, I suggest just favor the direction of the previous trend, like the overall trend. Why? Because it tends to be more trendier, right? So it doesn't make any sense to go really against the trend, as the corrections don't last so long. They don't have enough follow through, from my experience. And this is what you also see. So we have the signal right here, and after that, so obviously down move, and then price drops, or goes sideways and then drops. So this would be a loser, this would be a winner. Why? Because it's in the direction of the trend. This would be a winner. This would not be executed because of the filter, like stop buy. This would be a winner, even though it's quite tight. And then here we go over into sideways market. And this could be worth a try. So if Forex is trending, don't go against the trend. Word of caution, right? Okay. Now, any questions so far? We have 8 minutes to go, so.
So does this strategy work regardless of the time frame?
Yeah.
So these seem like daily candles. It would work if it was 1 minute candles?
It will, but just for a couple of minutes, obviously, yeah. Yeah.
So you mentioned that the orange line was 20 moving average?
Yes.
So I guess the typical way to read moving average is if it's above then it goes, if it's below then it curves. So in this case, you just use the moving average to sense the directions and not really, even though price goes above, I see on some of your example, it's touching the upper band, you would still short it.
Yeah.
Then to the traditional understanding of the moving average, you're shorting against the 20 moving average?
I go in the direction of the 20.
So is this the direction, the way the direction is pointing?
Yeah. I mean, I have a second strategy according exactly to this. It's like a pullback and reversal of the pullback, like, following the trend. Oh, by the way, I have something prepared for you. Maybe you like this, where I explain also this strategy and the third one, according to the Bollinger Bands and to the candlesticks. So these three strategies are perfect for all market stages. Yeah. Any more questions? All right. Speaking of, I know a lot of people, myself included, struggle with screening. A lot of people feel like, how can I find all these trades? And I have something. And this is called Trades Scanner. It's not my software, unfortunately or luckily, so I don't have to take care of it. But I partnered up with this, and it's a German software, German website. And with a Trade Scanner, you can scan the markets within a second. And I mean all markets, worldwide, stocks on a daily basis so far. We're working on, or they are working on weekly as well. Intraday doesn't make sense so much, as the signals are gone the moment you find them, right? So, but for end of day and weekly later on will be perfect. So what can you do? You can find the best trades within a second. You don't have to do the screening. So how does it look like? Like this. So you get like an assortment, you get like a list of all the trades that are possible, and of course you have to sort them out. Because some signals are very, very nice and some signals are like, I don't know, how it always is. So that's the homework we as traders always have to do. But at least you get a list of potential candidates and signals you can trade on. This is on a long basis, means buying positions, also on a short basis, so selling position. And you see, we were discussing the morning star. Here you go. So it's also there's a little arrow here. So you can find trades like this or CVS. I think it's 1 week old, this chart, or this one. So this would be a short one of CVS. And you also get delivered like, what is the potential risk-reward ratio? It just can be potential as the bands move and the target moves then as well. But still, you have something where you feel like, yeah, 2 to 1 is reasonable, I give it a shot. You use your risk management. For those who have my book already, you can read how this works, and then you're good to go as well. So these are examples. This is another one. What do we have here? I don't know what this is, but it looks good, right? So we have a shooting star right here, and already you have a nice risk-reward ratio of 4.5, and it's basically coming from a sideways market, and it's most likely to go down. I mean, you can, so it's almost 10 days ago, not really 19th or something like this. But you can look at the chart yourself and see what happened after that. Maybe it's interesting. Now that's number one I wanted to show you and introduce you to give you a little bit support and help in finding trades, because this is most annoying all the time, going through all the charts and finding this. We all know this, right? And also, speaking of the 3 strategies, I have a course I want to introduce you to, and I also like to give you for a very, very special price, together with 3 months of the subscription of the Trade Scanner. Now, how to trade on markets with 3 simple strategies. Now, I have presented you already one in 45 minutes, which is quite fast, actually. So this course is about 5 hours, and in this course I show you not just the expander strategy once again, so you can review it again, but also the other strategy, my touch and turn for trend following, and the third strategy, which I call double touchdown for really trend reversals, all according to Bollinger Bands and candlesticks. So if you like this is definitely a good deal from my point of view. So usually I sell it for $2.99, and now I give you this together with 1 free month of the Trade Scanner for $99. So you save over $250 with this one, and all you have to do now is just scan it. It's easy, and I will not ever show this again. It's the very end of the presentation, but it's not on my website, and it's nowhere else on the web, so it's now or never. Any more questions? Yes?
You say the forex, any other nuances that you see in the trend, any double confirmations that you're looking for trend reversal?
Double top?
No, double confirmations.
Double confirmations?
So trend heavy that you really need to see a reversal that makes sense to you?
It's not really according to the strategy, but especially with Forex, it's always a good idea to look at resistance and support zones, as prices usually bounce back into these areas. And if you see then the reversal sign, you have this confirmation already. Then you have double confirmation, from my point of view, right?
Wieland, have you tried, you talked about this Bollinger Band is 20-day moving average. Have you tried testing with different moving average days?
Yes, I did, but going back to the bell curve with plus and minus 2, I mean, we're talking about 90 to 95%. If we go higher than the minus or plus 2, we lower the probability of appearance, so we have less signals. Not good. If we go lower than minus and plus 2, we have a lot of signals which are most likely to fail. So honestly speaking, Mr. John Bollinger is a very clever guy,
Good average.
right?
I have a question. As
Yeah.
you know, I trade basic CQ data from CQ4. So, CQ data helps to find the trend, beginning of the trend, but this is not a timing tool. And what I saw today, it could be discrimination.
Yeah.
CQ data to find the beginning of the trend, and then to use Bollinger Band for timing.
Yes.
Did you ever try to combine CQ data with Bollinger Band?
I didn't, but I was told that this should be a good idea. But again, once you find yours, and that's also very, very important advice for all here in the room, once you find your idea of approaching the markets, stick to it. But of course, feel free to combine this idea the way you like it to work. And if you just say, okay, I just need the entry, I do my own management, feel free to do so. That's why I show you this, right? So yeah, give it a try. I will be happy to hear about it. Anything else? So, then, thank you so much for being here on a Friday afternoon in sunny Las Vegas, the Sin City. And I hope you liked this presentation. I hope that I could show you something where you feel like, yeah, I could use it, I give it a try. And if you have any more questions, feel free to reach out to me. The web knows me, and if you go to torerotraderschool.com, with or without a minus, you can find me there as well. And I would be happy if you go with the course and give this one a try. If you try the trade scanner, you can make your life much more easier. And therefore, I wish you all the best. I think I will be here next year again with another presentation, of course. So thank you so much for your time, and appreciate you being here. Thank you.